one or two more minutes in case there's any stragglers, and then um, this is enough information that you're going to feel like you are being fed from a fire hose. So um, I'm not trying to confuse you today. I do want to show you that there's a lot involved in first-time home buyer programs, and there's a lot of things that we have to consider. So, Alex, if you put your email in the chat, she will email you a copy of this. And because there's going to be a lot of information that you're just not going to be able to completely take notes on, but at least it'll give you enough information on the right questions to ask, and you're going to see that there's so many variations to first-time home buyers loans. You're just not going to be able to understand it all in one sitting. I've been at this for 25 years, and I have to take notes. So, but hopefully, as we go through, you can just unmic and ask a question. If you're too shy to ask a question during the meeting verbally, just put it into the chat, and Alex will interrupt me. And I like to answer questions when I'm on the page, because then we can reference the information that's on the screen for you. So ask a lot of questions, because it's not a real simple. It's not a simple discussion. There's a lot to these loan programs, and you just can't know everything. It's just the way it is. But that's what we're here for. We're here to guide people through the process, and we'll usually direct you to what program is going to be best. And there's always a best program, and then there's other programs you can get into that will be more expensive. So we want to show you which are the better ones, and then if you don't fit into those, where you can go otherwise. I am not going to get into these low document loans. There are loans out there for people when they're buying a home. They actually don't even have to show any income. It gets that crazy, but the down payments are higher, and I'm really just trying to gear this discussion for the conventional first-time home buyer programs, and some of the things that you should think about, or if you're a realtor, your clients need to think about when they are looking at the loan program. So they really need to be pre-qualified and have an understanding of what program they're going to be using before they ever start shopping. So, okay, I guess we should just get going, and maybe some people will join us as we go. So, okay, let me see how to advance the screen now. Okay, so our agenda, we're going to go through some definitions. We're going to talk about how to get approved. What are the key things that we look at? We're going to go through a bunch of loan types and show you kind of the difference of what the monthly payment would be. And I just created a scenario and ran every single loan type using the same scenario, just so you could see, what the monthly payment difference is on each loan type. And then we're going to talk about at the end how you get qualified. You need to know what you qualify for. You're not going to leave this seminar with what you qualify for, because as you're going to see, it's a pretty complicated process for us to go through with each of you to get you qualified. But you're going to know the components of how you get qualified. And then we're going to talk about why you could buy. And now is probably the best time in several years to purchase a home, in my opinion. And I'm going to go through some of the reasons why. So, okay. So just some definitions, and you can take some notes on this. I want to make sure that when I'm talking about mortgage insurance, you know what that is. So mortgage insurance is a fee that you pay when you borrow more than 80% of the purchase price. And this is an insurance policy that the investor gets in case you default on the loan and they don't get all of their money back through a foreclosure. The insurance policy kicks in and pays the lender the difference between what they get when they sell your home and how much of a loan is left. So it's just an insurance policy that you pay for, but benefits the lender. Okay, and then on USDA loans, we talk about housing expense. That's an important factor when qualifying for a USDA loan. They look both at your total debt to income and your housing expense separately. So your housing expense is the principal, interest, property taxes, property insurance, and HOA dues that you'll pay monthly for a home. Okay, and so we're going to explain to you what the limitation is, especially on USDA. USDA is the only one that really picks out the housing expense separately than other lenders. And then gross monthly income, it sounds simple, but it's not. It's all sources of your reported income that is expected to continue for at least another 3 years. Now, if you're a W-2 employee, that means your gross monthly income before any taxes are taken out. And there's some qualifications. If you get commissions or bonuses or tips, we have to do a 2-year average on those sources of income and add that into your salary. Now, if you're self-employed, gross monthly income is the net profit that you generate on your tax return before you subtract out the use of your home or something like that. And then we also add back in depreciation. So if you have a high depreciation expense, that reduces your net income. We get to add that back before we calculate what you're going to qualify for. So gross monthly income for W-2 people is your income before taxes and all your taxes. And for self-employed, it's your net profit. Now, the housing ratio, which USDA looks at, is your monthly housing expense, PITI, divided by your gross monthly income. And generally, the USDA doesn't want that to be more than about 1/3 of your income. And then they add other debt, and you don't want to be over about 41%. We're going to go into that in more detail. Okay, now the real important ratio is debt to income ratio. And we do this calculate this on a monthly basis. It's basically your housing expense and other monthly debt payments, the minimum payment, like on credit cards and car loans and personal loans. When you add those monthly obligations up and divide it by your gross income, you generally can never get above 50%. So you have to make twice as much gross income as your total monthly debt. Now, VA is a little different. You can get a little higher if you're a high income earner. You can get over 50%. But generally, it's a rule of thumb. If you make $10,000 a month, you can only have $5,000 a month in a housing expense and other debt payments. And the other debt payments really do factor in with some people. So it's always great to have less debt before you buy a house than more debt. The other factor is credit score requirements. Now, everybody's probably heard about credit scores. The higher the credit, the lower the interest rate, the lower the mortgage insurance, the better for you. So credit scores are all important. FHA has a program for people with troubled credit. So you can have bankruptcies and foreclosures and things like that. We usually look to FHA if somebody has challenging credit, or we try to help them improve their credit. But generally, for most all other loans, you have to have a credit score of 640 or higher. You really want to be in the 700s if you want good rates, okay? The definition of a first-time home buyer is that you have not owned a piece of real estate in the last 36 months. Not to say that you can't buy a property, but you just can't use some of the first-time home buyer products. And that's kind of limited. VA, you can use VA loan anytime, even if you own a current home. And then the definition of loan to value. Loan to value is simply how much of the purchase price are you borrowing? Are you borrowing 100% of the purchase price, 97%, 95%? Again, if you go over 80%, you generally are paying mortgage insurance. There's an exception to that, and that's the VA. So those are some of the definitions just that we're going to be talking about. I just wanted to go over that. Okay, so basically when you qualify for a loan, there's 4 areas of qualification. First, your credit worthiness. And it's not only your score, it is also whether you've had a mortgage late, you've had a bankruptcy. There's a lot of other things that we have to look at. I had one client that had a financial fraud case brought against him, and we couldn't lend him no matter what his FICO score was. So we do look deep into the credit report, but generally the higher the FICO score, the better deal you're going to get. Then we look at income, and it sounds easy when you look at income, but for people that earn commissions and tips, we have to average what you've earned over 2 years, 24 months. If you're self-employed, generally we need 2 years of self-employment. There are exceptions to that. Then there's assets. What are you going to do for the down payment and the closing cost? And then you also have to have post-closing reserves, which means we have to show that you can pay your mortgage for a couple of months if you became unemployed. So you got to have a little bit of money left in the bank after closing. So we do look at those assets, and we do look at seasoning. For you to use income or money that's in the bank, it generally has to be there for 2 months, or it's got to come from a source that we can accept. So let's say you sold a car. If you have the bill of sale, we can use that cash for your down payment and your closing costs. But for the most part, you need to have assets in your bank account for 2 months. Again, the exception is generally at the sale of something, or if you're going to get a gift from your parents or another relative. And finally, we look at the property. In Hawaii, there's a lot of issues with property. If there is termite infestation, if the roof is leaking, if the flooring was torn up, if there is exposed wiring, if there are unpermitted structures, all of those things can cause the lender to deny the property. And we'll go into more definition to that. So the next thing is FICO score. Again, generally you have to have above 580 for FHA and all others above 640. We do look at lots of other things: unpaid collections, tax liens, bankruptcies, late pays, foreclosures, judgments can all override the FICO score. So we do have to take a deep dive into credit reports. And that's why we pull credit reports, is because you can't just give us a credit score. There's much more to it than that, especially if you had a mortgage laid on another property or something like that. But the higher the FICO, the better the rate. And then getting back to income, remember, you need to have generally 2 years of work experience in the same line of work. Self-employed borrowers, 2 years of tax returns. Now that there is an exception to that. If you are a college graduate that leaves college and is working, let's say, for only 1 year in your line of work, as long as your education was related to that line of work, then there's no 2-year requirement. So, and that also applies to trade schools and other kind of education. If you were educated to be, let's say, a dental assistant or something like a nurse practitioner or something like that, it doesn't necessarily have to be a college degree. And then I mentioned that overtime and commission, you have to have a 2-year history for us to average. So if you've only been working, let's say you've got a job at the Four Seasons as a waiter or something, and you're making good tips, but you've only been there a year, we can't use that tip income. Okay, so there's seasoning to that. Okay, so on debt to income ratios, every lender is a little bit different, or every loan type is a bit different Generally for USDA, you cannot go over 41%. So when you add up the housing payment and all your other debt payments, it can't be more than 41% of your gross income, or if you're self-employed, your net profit. For FHA, they like it around 43, and 45% is generally the rule of thumb with all other lenders. You can go higher. You can get up to 50% if you got good FICO scores. And VA actually allows veterans to go up as high as 60 some percent, but they have to be very high income earners so that they've got a lot of money left over for living expenses. Okay. So the debt, when we're calculating debt to income, again, is the whole housing expense. It's the principal, the interest, the taxes, the insurance, HOA dues, and then we add all your other monthly debt payments, and it's always the minimum payment. Some people pay more than the minimum. We're only looking at the minimum payment. And what really hurts the most are car payments. And you're going to see that for every $600 a month in debt payment that you have, it eats up about $100,000 of what you can borrow for a mortgage. So if you've got a car payment of $600 a month and the balance on that car is $20,000, you know, if you can get rid of that car payment, you can add $100,000 of mortgage loan debt. So that's about what it equals to. Okay. And again, the housing expense is the principal, interest, property taxes, property insurance, HOA dues, and mortgage insurance. Okay. Mortgage insurance is a big deal, especially with people with low FICO scores. It can be $400 or $500 a month. So that's an important aspect. Okay. And then we talk about your other debt payments. We always look at the minimum credit card payment, car payments, student loans, alimony, lines of credit, and all of that gets added to the monthly number. If you have student loans, but you're not paying on them because they are being, they're on hold for some reason, the payments, and you're not late on them, but you don't have to make payment on them. We generally have to use either 1% or 2% of the amount due as a monthly payment to calculate your debt to income ratio. So it's a pretty rough calculation. So a simple example is if you have a housing payment of $4,000 a month and you have other debt payments of $1,000 a month, and you gross the $12,000, then the debt to income ratio is 5,000 divided by 12,000, which is 42%. And that generally qualifies pretty easily. Okay.
Hey, Kurt, we have a question.
Yeah.
Now that the tip won't be taxed, how will they verify it so that it can be used to qualify?
Yeah. So it hasn't happened yet because it's not in full effect yet. But once the no tax on tips applies, we expect they're going to treat it like they do with all other non-taxable income. There is other non-taxable income like municipal bonds and things like, dividends on municipal bonds. But generally, we get to gross up that income by 25%. So let's say you're earning $1,000 a month in tip income. We pretend that you're making $1,250 in tip income. So it's a big benefit, especially for those that are earning a lot in tip income. And my guess is, and I've already heard this, is that employers are beginning to restructure their employees' wages to be more heavily leaned on tip income. And I've heard some crazy stories where they're actually going to add a base tip into the people's meal total, and that will be just a basic tip amount, and then you can add to that if you're at the restaurant. So I'm hearing that there's going to be some changes with restaurants, and companies like McDonald's are complaining that, hey, wait a minute, our employees don't get tips, and the answer to that is, why is that? Why don't you let people tip your employees? So I don't know, but that's a great question. Yeah, we expect it will we'll get to gross it up by 25%. Okay. Any other questions for now? Okay. All right. So pretty simple calculations. At least we think it is until you get into tax returns and things like that. Okay, asset qualification. I mentioned that you have to have seasoned funds or gift funds to cover the down payment, closing cost, and reserves. Seasoned funds mean that the money's been in your bank for 2 months, and if you had made a large deposit to get it there, let's say you cashed in, you took money out from under your mattress that you've been squirreling away, and you went and put it in the bank. We can't use that money. We call that mattress money. We can't use that money for 2 months. Now, there are other issues around crypto. Some lenders allow you to liquidate crypto for down payments. Others require you to liquidate it 2 months in advance. So that's a changing world around crypto. Now, the good news is that gift funds can come at closing as long as it's from a relative. And, in Hawaii, I understand everybody's an auntie or an uncle, but, and nobody checks, but they have to write a letter saying what relation they are to you, and they have to sign it. So, it's a legal document that they say, I'm going to gift my niece or my nephew or my son or my daughter, $100,000 for them to purchase this house. We need a letter from that gift. So we don't have to season gift funds, which is good. So an example, let's say you're buying a small condo, $450,000, and let's say we're using one of the first-time homebuyer programs that requires a 3% down payment, and you've got other $4,500 of other closing cost, and then you also have to show reserves of 2 months of the housing payment. Let's say that's $7,000. You would need to have about $25,000 of liquid assets that are seasoned or gifted in order to close on that transaction. Now, we're going to talk about some programs where you can get down payment assistance and eliminate the 3% down payment. We can easily negotiate the closing cost into the purchase contract with the seller so that the seller pays the closing costs. We do that all the time. So frankly, the only money that you really have to have are reserves. And generally it's 2 months of the housing payment, the PITI, so principal, interest, taxes, insurance, and HOA dues. And you don't need to spend it. We have a lot of clients that come to closing with no money. They don't put a nickel into the deal. All they have to show, they've got a couple of months of reserves. And that happens all the time. So people that don't have a lot of money in the bank can still buy property if we structure it properly. Okay. So the property qualification is just as important as everything else. The home has to be in a habitable condition. The exception is when you're going through a renovation program. Renovation programs require a 5% down payment, and we will lend 5% of the cost to buy the property and 5% of the cost to renovate the property. So it's an exceptionally good program, and you can go after, kind of a fix and flip or fix and keep type of deal, and you can really get into some pretty rundown properties. And you can make a lot of money doing that, fixing up a property, and you get equity right there. So those are good programs. I'm not talking about renovation programs here. That's another seminar, but those are good programs to make money at. Yeah.
Kurt, we have another question.
Yeah. Mm-hmm.
If my partner has never purchased a home, but I have, and she doesn't have a significant income, but I do, are we able to leverage or access the first-time home buyer benefits?
Now, there are certain loans that one of the people has to be a first-time home buyer. So it does eliminate some programs, but Generally, we have 100% financing up to $1 million. The only benefit for these first-time homebuyer programs is they reduce the price adjustments. So you get a slightly lower rate. You're going to see that in a slide coming up. So the main benefit to a first-time homebuyer program really are two things. You get a slightly lower rate, and you can also get down payment assistance. Some programs, at least one person has to be a first-time homebuyer. In some programs, both of you do. Okay, so we just have to, go through your situation. So, and again, if you haven't owned a property in 3 years, then you're still considered a first-time homebuyer. So the property can't have any health or hazard problems. Generally, we see like decks with missing boards or handrails that are loose and people could fall off a deck. If the property has a lot of unpermitted additions to it, they may eliminate that as a possibility for a loan. And then there's a lot of other things in Hawaii, like shared road access, shared water meters, shared cesspools. Some of that stuff's not allowed, especially shared cesspools. If you're off grid or on water catchment or doing farming activity, you might get turned down. Generally, we can get past that if it's common for the area. And again, if there's just a bunch of obvious problems, a leaking roof, termite damage, structural issues, exposed wiring, flooring that's been torn up, you're not going to get a loan. You'll have to go for a renovation loan. Okay, here's some advice, and this you might want to write down. If you're a first-time home buyer or any buyer, frankly, try to reduce your debt as much as possible. I've had clients that walked into my office. They had bought 2 new vehicles. I think one was a pickup truck with a $900 payment and a van with a $600 payment. And we convinced them to sell their cars and buy junk cars. And it got rid of $1,500 in monthly payments, which increased their borrowing capacity $260,000, if you can believe that. So the more you reduce your personal debt, for every $600 a month you reduce your personal debt payments, you add $100,000 to your borrowing capacity. So that's the most important thing. We're going to talk about also credit scores. If you have bad credit, hire a competent credit improvement company. We can make recommendations. They know what they're doing. I've also seen if you just don't have a lot of credit, I've taken somebody from a 620 to a 760 in 30 days. If you can believe that, 140-point improvement in 30 days. And the way we did it, we had them add 3 credit cards from a family member or a friend, and they got added to that credit card as a responsible additional card holder, meaning that you give the credit card company your social security number, and you're technically responsible for making sure the payment gets made every month. And you want to have a card that has a high credit limit, but the person never charges more than 30% of the credit limit. Even if they pay it off at the end of the month, if they run it up past 30%, it's bad. And they've had a long history of on-time payments. So if you can add 1 or 2 or 3 cards, and you don't need to get a credit card from them, it's just you instantly get all of that credit history onto your credit. So it could be 10 years of credit card history, a perfect credit card history. So that's a way almost to instantly boost scores. It's kind of sly, but it's legal. So anyway, so that's an easy way to boost credit. Also, if you're limited on money, negotiate for the seller to pay your closing costs. And it's so easy to do. If you're negotiating with a seller and come to an agreement on the selling price, call them back up and say, hey, we got a deal, but we would like to raise the selling price by the amount of the expected closing cost. and we would like you to credit that amount back to the buyer to be applied to their closing costs. Well, the seller doesn't care. It's the same amount of money the seller was going to get anyway. It has no tax implication to them, but it'll cover your closing costs. Now, the only condition here is the property has to appraise at that higher price. So, but that's a great way to save, $10, $15, $20,000 when you buy a home. Okay. Now, also think about a family gift for the down payment and closing cost. So if you have a parent or a relative that wants to help you out, especially if they can get you to a 20% down payment, then you eliminate mortgage insurance. And again, a mortgage insurance can be $300, $400, $500 a month. Okay. Also, if you are having trouble qualifying for the property that you want because you don't have enough income, you can add a friend or a family member who has good credit and strong income to the loan as a non-occupying co-borrower. And we do this all the time with parents. So let's say the parents are, they don't have a lot of debt and they're still making income. They go onto the loan. The good news is after the loan closes, if you make a 12 months of payments from a bank account that doesn't have their name on it, so we can show that they didn't contribute anything to the mortgage payment for the last 12 months, then when they go to apply for a loan, if they prove that to a lender, that mortgage payment doesn't count against them. So it's still on their credit, but we don't count it into their debt to income ratios after 12 months. Okay. Now, if you miss a payment, it's going to hurt their credit, obviously. So, and the final bit of advice that I can give is if you're really struggling to get into the Kona or the Hawaii housing market, look for properties that you could, again, maybe use a non-occupying co-borrower to qualify for, but that it has some living space that could be rented out, maybe locked off, or it has no HANA, and you can generate income. I just closed for a fellow that the property had 2 full homes, and one of the homes was broken into 3 rental units. So while the monthly payment for the property was way over what he could afford, once you count in all the rent, he was making the payment easy. So he was having 3 different renters pay most of his mortgage payment, and he lived in a part of the home and could make it work. Now, generally, we cannot use that rental income to qualify. But again, if you have a non-occupying co-borrower and you can rent out your home to make it more feasible for you to live there, we're seeing a lot of that in Hawaii because that's just the problem with Hawaii. It's become less and less affordable. Okay. Any questions to now? Alex, is there any other questions?
Nope, not at the moment.
Okay. So now we're going to just talk about the high loan to value loan types. The best loan out there by far is a VA loan. If you served in the military or you had a spouse that served in the military and maybe had passed, there's no mortgage insurance. It has lower closing cost. It has a lower interest rate, but it does have an upfront fee. First time use is like 2.15%. Subsequent uses are 3.3%. And you can add that to the loan amount. So you don't have to pay for it out of the gate. It gets rolled into the loan. So that's the best loan out there. And right now, the VA home loan rate, if you've got good credit, is 5.5%, if you can believe that, 5.5%. FHA is a good loan too. It's generally for people with credit problems. And for the Big Island, it's probably not a loan that we look to very much because it has a loan limit of something like 530 some thousand dollars. So you can't buy much for that. But it is, you have to put 3.5% down. It also has an upfront fee of 1.75% that can be added to the loan amount. And it has mortgage insurance, which is the loan amount times 0.35% and divide by 12 would be the monthly payment. So it's a lower mortgage insurance. It also has a subsidized rate like USDA. The current rate on an FHA loan, 30-year fixed, is about 5.375%. So crazy good rates, crazy. Now, if you don't qualify for any of those, and there's going to be reasons why you won't, you can go and get a 97% loan from Fannie Mae or Freddie Mac. They also partially subsidize the rate. The rate on those loans is about 6%, maybe 6.125%. But they have income limitations. So if you make too much money, you can't get one. If that's the case, we also have other 97% loans that have no income limit with a higher rate. And finally, we do have a loan we can finance 100%, no income limit, up to $1 million. And that's a special loan for Hawaii. Okay? So those are the different high loan to value loans. A general conforming loan goes up to 95%, and you don't have to be a first-time home buyer and any of that. Okay. VA loans, again, active duty, veterans, reservists, National Guards, and spouses with who had a veteran pass away.
Kurt, we have a quick question from the previous slide. What's
Okay.
the income limit for USDA?
Okay, it varies by island. So in on Big Island, I think it's 139,300, and then on Oahu, it's like 163,000 a year. Maui is like 87,000 a year. I've got a little slide for that. So, but every island is a little different. Generally, you're not going to be able to buy a very expensive house with USDA because not only does it have an income limit, but the housing expense can't be more than like 31 to 33% of your income. So USDA is a very small box for most buyers. And that's frustrating because it's a great loan. I mean, it's a great loan. Has low mortgage insurance, small upfront fee. Okay.
Okay, and we have one more, Kurt. Do you have to wait a certain amount of time to rent out part of the property after you purchase it with the intention of using another part as a primary residence?
No, as long as your intent is to live on the property, you can go into the deal with pre-signed rental agreements. You know, they don't care as long as you're living there. But if you buy one of these properties with the full intent of renting the whole damn thing out, that's mortgage fraud. And, you know, you're hearing about some people that might go to prison for that, that are in the political arena. So yeah, make sure you live in it, and you can rent it from day one. Good question. Okay, VA loans. As far as I know, there's really no max loan limit, but for most lenders, it's $4.5 million. So you can have veterans who are CEOs of big corporations, and they can get 100% financing. And again, there's only a funding fee, and it can be as low as 1.25%, goes up to 3.3, unless you're a disabled veteran, where you don't pay any funding fee. There is no mortgage insurance. It's our thank you for serving. Debt to income, generally you have to be below 50%, but there are some exceptions, if I could spell the word exception right. And there is no income limit. So by far the VA is the best loan out there. Minimum 620 FICO score. Some lenders require 640. And this is a chart of the VA funding fee, first time use 2.15. If you put a down payment down, it goes down. And you would still want to use a VA loan, even if you're going to put 10% down or something like that, especially on subsequent use loans. So there's a chart, and these charts change occasionally. So you can get a copy of this chart. Okay, USDA loans, we're going to go into more depth. It's from the Department of Agriculture. It's for rural communities. You don't have to be a first-time home buyer, and you can own a second home. Let's say it's on the mainland or something, and still get a USDA loan. The only place you can't get a USDA loan in Hawaii is Hilo, and most of Honolulu, Hawaii Kai, the true urban areas of Oahu. Everywhere else you can get a USDA loan. Max loan amount is $1,209,750. There's a 1% fee up front. You can roll that into the loan amount, so you can borrow 101%. Mortgage insurance, which is quite low, is 0.35% and declines over the life of the loan. Now, Big Island is the worst in all of the islands. You can't earn more than $139,000 if you don't have more than 5 people in your family. If you have 5 people, it goes up to $183,500. Each island besides the Big Island is higher than this. They go up to $204,000 for families of 5, and I forget what the household income limits are on each island. But the problem is with USDA loans, they generally say that you can't spend more than 29% of your gross income on your home expense. So that's a real limiting factor. And you can go up to 33.9%. So if you're on the Big Island and you have $139,000 a month in income, that means the housing expense it has to be between $33.59 and $39.27. So if your housing expense is going to be more than that, we have to rule out the USDA loan program. And also, your total debt cannot exceed 41%. I've seen it go a little higher than that, but generally it's a pretty hard stop at 41% debt to income. So just because of this housing expense limit, USDA really applies to inexpensive homes for the most part. You got to have a pretty inexpensive home, maybe $500,000 or $600,000. And also minimum FICO score is 640. So here are the income limits for each island. So Maui is 154. Maui is 154 up to 4 persons, 204 over 5 people. Honolulu 174 goes all the way to 230 if you have 5 people in your household. Big Island is 139. And 183,500 for 5 people, and then Kauai is a little bit better than Big Island. So, and these numbers are driven mainly by the income reported in the east side of the Big Island. It shifts the median income down quite a bit. So, and then finally FHA loans. No, we got conventional after this, but generally, we only use these for people with bad credit problems. The biggest issue that we've got is the loan limit. So the Big Island is 551, 500, 550. On Maui, it's $1.9 million. Kauai's 1.1 million, and Oahu is only 779. Now, there's something interesting about FHA loans. Congress approved FHA loans in Hawaii and Alaska up to 1.8 million. However, we don't have a single lender that recognizes that decision by Congress, and we're fighting that through our legislature. But theoretically, FHA should go to 1.8 million on all throughout the state. And we don't have a single lender in the country that recognizes that. So we're trying to get that resolved. Again, the loan amount is 96.5%. You have to pay an upfront fee of 1.75%. Mortgage insurance is more expensive at 0.55. Typically, total debt to income is supposed to be less than 43%. I've seen it as high as 50%. The good news is on FHA loans, there's no income limit as long as you can stay below the loan limit. And the minimum FICO is 580. You don't have to be a first-time home buyer. And it does allow for significant credit problems as long as you have them behind you. So if you've got an outstanding debt that needs to be collected, you got to pay that off. So we don't see a lot of FHA loans on the Big Island, although they're very popular elsewhere. And they should be popular on the Big Island if any of the lenders would recognize the true FHA loan limit for the state of Hawaii at 1.8 million. Okay, and so here are the FHA loan limits. Again, this is from FHA. And if you buy a duplex, a triplex, or a fourplex, you get a lot more, obviously. We don't have a lot of duplexes and triplexes and fourplexes, but if you do find one, you can borrow a lot more. Okay, now Fannie and Freddie, now they have their own first-time home buyer programs. The max loan amount is $1,209,750. You can borrow up to 97%. 3% down payment must be from the borrower's seasoned funds for at least 2 months, or a gift from a relative. The debt to income can be 43 to 45. You can go higher if you've got a high FICO. Minimum FICO is 620. Most lenders overlaid is 640. Loans over 80% must pay mortgage insurance, and this is the highest mortgage insurance that you're going to see. Depending on your FICO scores, it'll be 0.45% of the loan amount, up to almost 1% of the loan amount per year, and you divide it by 12 to get your monthly. And you can get rid of the mortgage insurance if you hold the loan for at least 2 years and the loan to value drops below 78%. So it's not a forever mortgage insurance. Some of the other loans, it is forever, for as long as you have the loan. Okay, so we really have kind of three types of these high loan to value loans for that are conforming. I think the best one is we can lend you 100% of the purchase price. There's no income limit. It has a higher mortgage insurance. That's the negative. And generally, you have to have a 45% debt to income ratio. You can bring in non-occupying co-borrowers to bump up what you can borrow. And again, you can have your closing costs to be paid by a gift or paid by the seller. So this program, we can get, people that are making a pretty darn good living, but they just don't save any money. We can get you into a property with very little down, or maybe even nothing. It's a pretty good program. And then Fannie Mae and Freddie Mac each have their own program, which is 97%. And the first-time homebuyer program does give you a lower rate than the first scenario. So, and again, first-time homebuyers, no property lasts 36 months. Now, the problem with Fannie Mae and Freddie Mac's program is they have an income limit at 80% of the area median income, and you can go right online to see what that is. On the Big Island, it's like 83,000. Honolulu, it varies by area, but like 103. Hawaii's 106. Maui's 88. So for the most part, these Fannie Mae and Freddie Mac first-time homebuyer programs, you might get into a condo. You're not going to buy a really nice house, that's for sure. So again, we normally have to break away from these programs and go to the first one, even if you're going to put a down payment down, because with no income limit, you can get a high loan to value. But again, the rates on the first-time home buyer programs are lower. So that's the big benefit.
Kurt,
Yeah.
we do have a question. Do you offer portfolio loans if it's not, do you offer a portfolio loan if it is not conforming loans?
Yeah. And so what they're asking about, a conforming loan is a loan that gets sold to the big GSAs, which are called Freddie Mac and Fannie Mae. And these are government-sponsored entities that bundle all these mortgages and sell them into the bond market. And I watch that bond market all day. A portfolio loan means that the bank is going to keep the loan. They don't sell them, or at least they don't sell them to Fannie Mae or Freddie Mac. Now, the challenge with portfolio loans is the loan to value is not as high. The good news is you can get really good ARM rates. So adjustable rate mortgages. I hate to call them adjustable rate mortgages because for the most part, for the time you're going to own the loan, the rate is fixed for 5 to 7 years. And those rates are in the fives. But you're going to have to put more down, and again, it depends on the lender, but you're probably looking at, 10%, 15%, 20% down if you're going to use a portfolio loan. Now, if you can believe this, I'm only showing you a dozen loan programs. Last I counted, there are over 300 loan programs. So when you come to me and say, what's your rate on this loan? Well, it has 300 rates. So it's amazing how many loan products are out there. And we always want to go with a full document loan first, where you're showing your tax returns, because you're going to have a lower rate. And as we peel the onion of your financial situation, we may switch to a different kind of product. For example, you can buy as many rental properties as you want, and you can borrow up to 90% and never show a tax return. So if you've got 10% down, you can buy as many rental properties as you want. And what we use is the income from the rental property to qualify for the loan. And that's called a DSCR, or a debt service coverage ratio loan. You can also not show your tax returns, but show your bank statements. And we use your deposits as income. So for somebody that pushes a lot of cash through their business checking account, they may not show a lot of income on their tax return, but all of those deposits in your business checking account we use as income. So there's, again, 300 loan programs available out there. And I can't know them all. I mean, we have to do research. But when we analyze your situation, it steers us to the right loan. So let me show you the analysis that we do. It's not as complicated as this, but so if you walk into well, go ahead.
Sorry, Kurt, we do have another question on that previous slide as well.
Okay.
About Home Possible and Home Ready, what they are.
Oh, I'm sorry. Home Possible and Home Ready are the jargon word for Fannie Mae and Freddie Mac's first-time home buyer product. So Fannie Mae is Home Ready, and Freddie Mac is Home Possible. They're basically the same thing, but they have different rules. So I always like to go with Freddie Mac because they have looser guidelines, but they price out pretty much the same. So yeah. So if you hear the word Home Ready or Home Possible, that means you're going to be limited on the income that you can earn. Again, we don't do a lot of them because it's hard to buy a property with those income limitations. But we have plenty of other loans. Fannie Mae and Freddie Mac offer a 97% loan that is not for first-time home buyers and has no income limit, but they don't give you the pricing breaks that they're giving a first-time home buyer. But it's not all that significant, to be honest with you. It's about an eighth of a point in rate, maybe a quarter point in rate. It's not so significant that you should be worried about it. I very rarely found a client that I couldn't get them into a loan unless they just had disastrous credit, you know. And there's just so many loan products available. So if you look at the analysis, this is in order of the best to the worst, okay, if you're looking at first-time homebuyer programs. So VA, if you follow along, I'm using all the same purchase price, $750. You don't have to pay a down payment. There is an upfront fee of $16,125, so the loan amount would be $766. Interest rate 5.5%. You might pay a little bit in points, which you do have to pay cash at closing. Then you have closing costs. You have the monthly principal and interest payment. And let's say it's the same property, so the taxes and insurance are all the same. This property, without putting anything down, would have a monthly payment of $48.49. That's the lowest one that I can give to you. Now, USDA, again, no down payment, a smaller upfront fee, a lower rate, maybe a little bit higher in points, a lower monthly interest payment, monthly principal and interest payment, but lo and behold, it has mortgage insurance. But it's pretty low for when you compare to everything else. Same taxes and insurance, so it would have the second best monthly payment. But I'm telling you right now, this monthly payment exceeds what you can get due to the income limitations for most islands. So you're gonna blow the housing ratio with this number. So for the most part, you could not buy a $750,000 home using a USDA loan. We have to go through the calculations. FHA, okay, you have to have a $26,000 down payment, 3.5%. There is an upfront fee. You can roll the upfront fee into the loan, so you'd have a loan amount of like $736. It has a very low interest rate, low points, lower monthly principal and interest, but look at the mortgage insurance, it's higher. So it has a little bit higher payment than USDA. It doesn't have the income limits, but it's got a loan limit. So you couldn't buy a $750,000 house on the Big Island. You could do it on the other islands, okay? And then Fannie Mae and Freddie Mac, I'm not sure why I did two of these. They're identical. So you have a down payment of 3%. There is no upfront fee, $727,500. You can see how much higher the interest rate is, 6%. Maybe small fee in points. You can see the mortgage insurance. Now look, the monthly principal and interest. Now look at the mortgage insurance is even higher. So you would have a $5,200 a month payment, and it also has income limitations. So you're probably not going to buy this home either because of the income limitations. You'd have to get a smaller home or a condo. But we do always have a fallback of our 100% conforming. $750, no down payment, no upfront fee, $750 mortgage, only slightly worse interest rate, some points, closing cost, principal and interest is a little bit higher because it's a little bit higher interest rate and a bigger loan amount. The mortgage insurance is a little bit higher because it is a 100% loan, not by much. So it would have a $54.26 monthly payment. But this, you almost can't be denied this loan as long as you meet 45% or 50% debt to income ratio, because there is no loan limit and there's no income limit. So this is kind of our fallback. And then we have a bunch of other loans that, are really not geared for first-time home buyers necessarily, but even if you are a first-time home buyer, we can put you in. Okay. Pretty complicated. It looks obviously, but we do this for you. We'll do all the calculations for you. and we will steer you into the loan that makes the most sense. Now, there are also types of down payment assistance. There is forgivable down payment assistance that gets built into your loan. There's no repayment if you stay in the home for a set period of time. Sometimes it's 5 years, sometimes it's 10 years. And they forgive that down payment assistance, and it could be up to 5 or 6%. The problem with this down payment assistance, they build it into your rate. You're going to pay a higher rate. They get their money one way or another, so there's no free lunch. Now, there are grants that offer down payment assistance. Hawaii has some. They run out of money all the time, and this is a true gift. There's no repayment required. Sometimes there are some deed restrictions where you have to stay in the home for a certain amount of time, but that's truly a gift. There's a deferred payment down payment assistance loan. It's 0% interest. No payments are due until you sell, refinance, or pay off your mortgage, and then you have to pay it back. Then there's the repayable down payment assistance. So again, you can get 100% on any loan type, and that down payment assistance actually operates as a second loan with its own monthly payments and usually a reasonable interest rate. And then there's always one we can always do, and that virtually every lender can allow some lender paid assistance. And all we do is increase the rate and generate a rebate to help you cover closing costs or part of the down payment. Generally, we can't get above the lender's your closing costs just because the rate gets pretty high. But that's another way to have assistance. And then remember, having the seller pay your closing costs is another way for down payment assistance. These are pretty complicated, so it's not something that we go lender by lender, and if you really have to have it, I always think there's a better way unless there's an obvious grant that you can get. Because these get pretty restrictive in the way they apply down payment assistance. And generally, you're going to pay for it one way or another anyway. So hopefully you don't have to pursue down payment assistance, which on our 100% conforming loan up to $1 million, you really shouldn't. Now, these are worksheets that we go through when we are pre-qualifying you. I'm not going to go through this, but we calculate your income. So here's an example of the next page. We calculate your income. We calculate your outstanding, here's your income, your outstanding debt payments. And then we look at each loan, what the limitations are, which one would apply to you. And so we're going to go through this analysis and provide you, our conclusions, like the USDA loan is the income limitation is too low, or maybe the first-time home buyer 97% program, you don't qualify because of the income. You don't qualify for a VA loan because you're not a veteran. So we'll go through and kind of steer you towards the best loan. And qualifying is really your first step, is just going through the process so that we can steer you down the right road, especially if there's credit issues that we need to deal with. And again, sometimes we can fix credit in 30, 60 days, and you'd be amazed. But you have to start somewhere. And where you start is doing an application and going through this process. But it's a very custom thing, not really easy to do in a seminar, but we do it one-on-one with you. Okay, and then and again, we're going to send this to you. Here's the list of documents we need to do your pre-qualification. Yes, it's a lot of paperwork. It's more for me than you, but, and we'll send you, if you want to do a screenshot of this, or Alex will send you this in the presentation. And this is where we get started. And I always think you should do it as soon as possible, even if you're going to wait a year to buy a home. we should do this because there are things that you can do over the next year that can make a dramatic difference. The last thing I want to show you is why should you buy? And I've got some clients that I work with. We're building up their real estate portfolio. I have a young guy with me for 7 years now. He owns 4 properties, and he's currently making over $400,000 a year in his properties. And he only makes $150,000 a year with Helco. So can you imagine? He's out there working 40 hours a week, making $150,000 a year, and his properties, which he doesn't have to put any time into hardly, I mean, some time, are making him $400,000 a year. And where it comes from is properties escalate. And right now, the escalation in property is a little lower than it has been. For 70 years, real estate has gone up 4.9% per year on average, every year for 70 years. And I think this is going to go up because we're not building enough homes. So if you buy $1 million property today, in 15 years, that property will be worth 1.9 million, and you would have paid down the mortgage $275,000. So the appreciation gain is 919. You've gained $275,000 in principal reduction. So you have gained almost 1.2 million over 15 years. Now think about that. That's more than $75,000 a year that you're gaining by owning real estate, and you don't have to go to work for that. $75,000 a year gets added to your net worth every year, on average. Now think about, what if you bought 3 homes over 15 years? Generally, I think you can buy a home every 5 years, refinancing your current home, using cash from your current home to make the down payment on a new home, and you do it again and do it again. So you're never putting any of your money into the real estate, because we can get you into a piece of real estate 100% today, and then 5 years, refinance it, pull some cash out, buy another home. 5 years later, you could actually refinance both homes and pull out money and buy 2 more homes. I mean, it's so if you get real estate working for you, it generally is the biggest portion of the average American's net worth. And if you own more than one, you're accumulating much faster. So again, my feeling is you should buy a piece of property every 5 years, almost by clockwork. So because you can see the equity advantage that the wealth that you're generating. And this is probably conservative. So that's all I have for you. So I'm going to open it up for any other questions. Alex, we have anything in the chat?
No questions in the chat.
You can unmute if you do have any last questions, but if not, I appreciate you joining us. And the next seminar, we're going to have a construction fix and flip seminars, how to buy property, fix them up and flip them, or live in them, whatever. But it's generally kind of construction loans. And is that on the 20th, Alex, or?
Yeah, our construction loans webinar is on the 20th at 11 a.m. And if anybody wants to join, I'll send them the link with the email with the slides if you want them.
All right. Thank you, everybody. And I'll let you enjoy the rest of your day.